Hello and welcome to another quarterly commentary video. I'm joined by my colleague, Jason Staley, our Chief Investment Officer on the personal side of our wealth management practice. How you doing, Jason?
Dave, it's good to be back with you again. It's kind of hard to believe that 2021 is kind of come and gone, and we're, almost 2 weeks into 2022. It's just, it went over really fast. That's for sure. Slow as kind of 2020 happened. Certainly felt like 2021 just was kind of over right as it started.
So we've been filming these, let's say, compliments to your quarterly letter for the last couple quarters.
Yep.
And, obviously I enjoy reading your insights and your perspectives, but before we get into the, nuts and bolts of capital markets, there's a couple topics. You mentioned your Cleveland Browns. So, I, being a Cincinnati Bengals fan, feel like I've got to bring up the fact that by the time this video drops, we will know whether or not the Bengals have ended their 31-year playoff drought. I will be at Saturday's game. A little fun fact, I was a 9-year-old boy in 1991 when the Bengals last won a playoff game. I was at that game, so I'm trying to pull on all the karma that is to get them off this 31-year schneid, if you will. So there's my piece of Ohio sports to add to this commentary.
I would like to add that my Cleveland Browns beat your Cincinnati Bengals twice this year, so 2-0.
And your Cleveland Browns will be watching my Cincinnati Bengals play in the playoffs. So you can have the W.
There's a reason that they call it the factory of sadness. It's not for everybody, but it is for the chosen few that are just gluttons for punishment. And there was so much to love about getting back to our lives in 2021. And just like clockwork, the Cleveland Browns crushed my soul yet again, that they've done for almost 22 straight seasons since they came back in 1999. So in a lot of ways, Dave,
as most Browns fans would say, hey, buddy, there's always next year, right? I mean, next year's your year.
Super Bowl
or bust. One other housekeeping item you brought up, arguably, if Super Tecmo Bowl is I think one of the best, if not best, of video games of my generation, NBA Jam. And so I had to do a little bit of homework, because my question for you is, all right, well, what duo in NBA Jam is your selection? I will show you my cards. I'm going with Tim Hardaway and Chris Mullins, or Charles Barkley and Thunder Dan. Those would be the two teams I'm picking at an arcade 20 plus years ago.
I think being such a Cavs homer, Mark Price and Brad Daugherty, that just will always be it. And Larry Johnson and Alonzo Mourning, because every time Larry Johnson would get on fire for the Charlotte Hornets, he could dunk from behind the 3-point line.
Grandmama, if I remember that commercial.
Yeah, exactly right. With the Converse.
Yeah.
Doing backflips and dunking the ball. But yeah, I thought I was trying to think about the best way to just say, what did the S&P 500 do in 2021? And I put a litany of things that it had that could have been potential headwinds, and it just kind of shrugged it all off. And I was like, man, that's like back when Brandon and I were playing NBA Jam. It's like it was just on fire. And I thought that would be a great way to describe it. And I think for those of us that played the game, kind of bring a smile to our face. And for those of, for our clients and for people that are watching this, that were maybe parents that had to deal with us, I'm sorry if your kids were nearly as obnoxious as we were when we were playing it. I apologize. So it just was one of those things where it made me smile thinking about it. I think that everybody that's played that game, hopefully you can remember back when, because that was a fun game.
So you basically just touched on, now if we get to the order at hand, you kind of just touched on 2021, right? I mean, on fire, right? S&P 500 just a shade below, up 29% for the year. You can see in the chart, real estate values, basically any risk asset arguably had a very strong 2021. Is that a fair big picture synopsis?
Yeah, I think that's fair. I think that the three main winners of things that were rising that were material to people, the S&P 500, real estate values, and wages. I mean, those were kind of like the three stories. And mid caps and small caps, had pretty good years. Small value did really well, was outstanding. International was kind of high single digits, but emerging markets, I think was up almost 18.5% in 2020. and it was negative in 2021. So I would say the three big winners in 2021 were the S&P 500, so mega cap, large cap stocks, real estate values, and wages for employees.
Fair to say. I mean, I'm going to rattle off the last 3 years, calendar years for the S&P 500: 31 in 2019, 18 in 2020, and 28 in 2021. I think it's fair to say, if you believe in reversion to the mean, which means what's the long-term average of the S&P 500? 10%, give or take, maybe high, in that ballpark. Unless we feel like the average has been changed, at some point that other shoe has to drop, right? Is that too rational of a thought to apply to capital markets?
I would say that kind of being rational and using fundamental analysis at times has been a fool's errand during the last 3 years. But I certainly think some of the tailwinds that the U.S. that have really done well for the U.S. are going to start to become headwinds. Low interest rates, highly accommodative, fiscal measures monetary measures from the Federal Reserve in terms of injecting liquidity into the market, and then kind of the strength of the U.S. dollar. I think that those are all things that kind of hurt risk assets kind of outside of the U.S. and really help risk assets inside of the U.S. And I also think the market was just willing to absorb and move past a lot of different narratives. And we've seen in the first 13 days of 2022, we got a 7 handle on inflation, on CPI and
you had north of 6 the previous 2 months. I mean, let's go there since you opened that door, right? So you mentioned the Federal Reserve and liquidity, and I think that contributes a lot to a very strong 2021. But you're right. I think the Fed has come out and acknowledged inflation's running hotter and faster than it thought it would for longer than it thought it would. So then, I think the general street expectation is, by March, the bond purchases run its course, and then, that sets up for 3 rate increases. So I'm going to state the obvious: rate increases are generally a headwind for taxable bond investors, right?
Well, I think certainly for taxable bond investors, obviously bonds are a seesaw. So to kind of go over it, as prices go up, yields go down, and then as yields go up, prices go down. Kind of that's a fundamental relationship, and we've certainly seen that. I think the 10-year U.S. Treasury yields up almost 25 basis points to start the year, which doesn't sound like much, but in percentage terms is a very big number, going from like 1.5% to 1.75%. As we kind of record this today on the 13th of January. And then I also think that, interest rates also affect U.S. equities. When you have a low interest rate environment, you're able to, the discounted cash flows, so kind of future earnings, look better when your cost of capital, when interest rates are low. And as interest rates go up, the present value of those future cash flows are not as great. And I think that some of the volatility you've seen in some of the technology sector to start the year is certainly kind of indicative of that, where I think it used to be, and I think the way that I framed it in the letter was that the thought of higher interest rates was an abstract thought for the last 3 years. Mm-hmm. Because ever since kind of 2018, when Jerome Powell tried to get liftoff in the middle of the Trump administration, kind of right in the middle, and kind of caused a really big equity correction, kind of 20% or so in kind of major market indexes. We've been on this declining interest rate environment, and then COVID hit, and that really hit reset on any sort of kind of rates liftoff. And with all of the fiscal stimulus measures, the stimulus checks, all of the PPP loans that came in and really helped reinforce company balance sheets. As that money got back into the system, you had the consumer demand just kind of really spike inflation. And I think the Fed, as to your point, thought that it was going to abate. And that's why they used the term transitory, which they were forced to drop in December, because it's not transitory. And while I don't think that we're going to be printing 7 handles on the CPI every month in 2022, we're going to have elevated readings of inflation to the point where the Fed has now stated that they're going to have to raise interest rates. And Fed governors have come out and said, it might be more than 3, it might be 4 interest rates in 2022. Jim Bullard, the chairman of the St. Louis Feds, came out and said that yesterday.
Well, it's fair to say with all the liquidity, and this is just my opinion, but the Fed has backed itself into a corner here because of all the stimulus and now inflation running hot. And historically speaking, and you know this stuff better than I do, but historically speaking, the number one way to fight inflation is you got to raise rates, right?
Yeah, unless you're really accurate in your forecast that inflation will be fleeting, right? That it's just a blip on the map and then it's
but every month that goes by, the confidence level in their ability to forecast that accurately is going down, right?
Right. You look at kind of energy costs, wages, and kind of rent, right? Both kind of rent in the traditional kind of multifamily or what kind of home sales are going for. It's just we're living in an elevated environment where things just cost a lot more than they did 18 to 24 months ago. And so when you think about raising rates, it certainly affects the bond market. And it also affects the equity market because the equity market's going to take a few months, maybe even a few quarters to really adjust to higher levels of interest rates. And I think that we don't really know how the market's going to react because there's a debate about how much of this is actually priced in. And I think that's the reason for us when we look at kind of having diversified portfolios. We think you need to have other answers to the portfolio than just stocks and bonds because investing isn't black and white. We think that there's a third way, kind of that gray area that exists in life. We think there's a gray area that exists in investing. And we think that there's a real tangible benefit to having a portion of your portfolio in the gray, kind of in between stocks and bonds.
Yeah. So, I mean, you kind of just gave indirectly a little bit, right? An outlook for 22, right? I mean, I'm not going to go so far as to say we're going to make any bold predictions here, but I think it's a fairly reasonable conclusion. Bonds are going to be challenged. We've stated it before. You hold bonds for two reasons. Right now, it's probably for one reason. Look, if we really see things hit the fan, you want some dry powder to be able to lean into sell-off. Bonds should be able to provide that, right?
Yep.
Domestic international stocks, or I'll throw in emerging markets there. We kind of talked about that. But look, domestically speaking, it's been a home run to be in the S&P 500 for the last 3 years, right? Can that continue? I'm not sitting here saying it can't, but at some point, international and EM is just going to get so favorably priced. And we were talking about this kind of in the prep for this video call, right? That you had a stat on the standard deviation and the differences there between the two, right?
Yeah, JP Morgan came out in their guide to the markets and looked at the international equities where their forward price to earnings was relative to the S&P 500. And right now it's trading at like a 33% discount, which is almost a 3 standard deviation event to the inexpensive or to the cheap side. Is it possible that it could always get cheaper? Yes, it could. But history is suggested that these things kind of revert back over time. And I think our view is kind of from a next dollar of risk capital, and we certainly think that international, both developed and emerging, have a better return outlook just from where you're buying in from a valuation standpoint. In the case of emerging markets, there's a growth story to go there, but kind of broad U.S. equities versus kind of broad international and EM, we think that there's the international is priced a little bit more favorably. And then inside of the U.S. market, we think that value looks really good as a style. I think when you look at large value, small value, they look really attractive relative to growth. And now the one thing about value that kind of has going in its favor domestically is there's a little bit of momentum to it. You're starting to see some of these reflationary names and these cyclical names start to catch a bid. And I think part of that is the market starting to come around to the realization that rates are going to go higher, and some of these cyclical companies actually do better in an environment where rates are going up. Financials would be kind of a really good example of this.
Financial and energy are the two sectors that are having a phenomenal start to the year, right?
Yes.
Well, and I mean, all of this looks and feels like 2022 is setting up to, it's easy to say, but I think it's fair to say it's going to be a much more volatile year. 2021, if we look at the S&P 500, I don't recall the exact stat, but basically we didn't even experience a correction throughout the year, right? In a normal year, you might have, if not one correction, several bouts of volatility throughout the year. It was if I think of like if you ever water skied, the water was very kind of smooth and very easy to invest in hindsight, right? It's never easy to invest in the moment, but I think it's fair to say 22 is off to a much choppier start.
Yeah, I think that it's kind of you never want to. Your predictions like this are really difficult, like whether you're going to see a lot of volatility, because no one expected. I think that the high of the Wall Street estimates on the S&P 500 was like 4,300, and we finished at like 48. I mean, this stuff is really hard, but I think from just higher interest rates, persistent inflation, and I think that there's just a lot of, and then you add in all the geopolitical things that are kind of going on that we don't really touch on because it's not really our subject area of expertise.
Right.
But yeah, 2022 suggests that there's going to be more volatility, and because of all the things that we've discussed, and I think that you have to have some things in your portfolio that you can point to that are able to to generate returns in sideways markets or in volatile markets. And like I think that you did a good job of kind of summarizing that stocks and bonds at least domestically at a broad asset class level are likely to be challenged. I think that's one of the things that we've leaned into. We've spoken about it over the last couple quarterly letters about real assets that have, kind of have positive, have positive correlation to inflation, and that whether you're talking about infrastructure, farmland, timberland, or high quality commercial real estate, these are all physical assets. So as inflation goes up, the value of these assets go up. But because of the highly contracted nature of these cash flows, they have inflation kickers in them, so that in the case of rent, you're typically paying 2 to 3% more per annum, sometimes more. In the case of commodity contracts, right, some of that is fixed, but some of that is floating. So you're paying higher. I think like everybody's energy bill is a lot higher, this winter than it was last winter, and that's just again a function of inflation. And those are the things that we're putting into client portfolios and that we're really leaning into, because we do think it's going to be a really difficult slog in kind of core fixed income, where the outlook hasn't been good for the last 18 months. And I think on the equity side, to your point about volatility, I think that we had 2 intraday points in time where the market pulled back 5%, but I do not believe that it closed down 5%.
Yeah, it never closed.
I don't think it ever closed down. I think the most it ever closed down was like kind of high threes. So you really just never got that pullback that you typically get. I mean, almost every year there's a 10% pullback. There wasn't for a lot of reasons last year. This year it stands that given the set of circumstances where 2021 was all about living in the moment and we'll deal with inflation when we have to. I think 2022 that bill's coming due and we're going to have to deal with it, and we can't really you can't ignore it any longer, right?
Right.
And I think
we got to do the dishes now. The dishes.
Yes, now we have to do the dishes.
We're gonna have to do some dishes. Yep.
Transitory doesn't cut it anymore. Like Jerome Powell can't go there because now that these senators and these congressmen are, he's going to his confirmation hearing this week, and he's going to get a ton of questions on it because it's a kitchen table issue. Everything costs more, and I think whether you're going to trying to get a car used, if you can find a used or a new car, like you better buy it because they're just not available, and the prices continue to keep going up. Similarly, I said sack of potatoes because we made baked potatoes over Christmas Eve, and I looked at my wife and I was like, really, this is how much this, like, I mean, I used to work at a grocery store, like shout out Ride Outside GA in Perry, Ohio, but like a sack of potatoes is like, I don't ever remember it being that expensive. So I just look at that and I think that these are the kind of things that are going to start to affect portfolios. Inflation is going to be mentioned. I bet you if you did a keyword search for all of these analyst calls that are going to be going on with these publicly traded company CEOs, inflation across all business segments, all line items, is going to probably be one of the hottest topics, if not the hottest topic.
Well, I think that's actually a headline in the Wall Street Journal today, that inflation has become front and center, argued for most public company executives, even more so than maybe COVID. So here's where I would wrap with, as I read your quarterly letter and kind of prepped for this. The thing that I shared with you was, one of the things that I find the hardest about investing is to be short-term aware, to be aware of current events, to be aware of inflation running hot, to be aware of domestic equities on a great 3-year run, if you will, but to constantly be investing for the long term. And I guess that's where I would wrap this discussion is, we can't accurately predict what 2022 has in store for us, but what I'm fairly confident in is we're going to continue to maintain a disciplined long-term investment approach. Will we get it exactly right? Absolutely not. But, you invest for the long term and let things play out. Generally, you're going to be able to compound capital at an acceptable rate of return for most individuals that'll make their retirement plan very successful.
Yeah, I think that you have to be short-term aware, because you need to be able to, as advisors, one of the values that you can bring to the table is explaining to clients what is going on with their portfolio, what's causing it to move up or down, and the fact that you're comfortable with this, that you have this understanding that allows them to stay invested, so that they get to, so that the time in the market matters, right? You need to keep as much capital in the market as possible.
Timing the market versus timing the market, right? The rest of that statement. Yep.
Yes. Yep. And that's why you being short-term aware, you're able to talk to your clients about it. And then I think that there's work that can be done around the edges, leaning into real assets that can be a value add, that are more of a strategic allocation that you can lean into during these times, but also just making sure that you have multiple things you can point at and say, this is what we put this into the portfolio to do, and allows clients to have a certain measure of comfort so that they can stomach the volatility. Because to your point from a few minutes ago, clients haven't had to deal with a lot of volatility. Certainly 2021 they didn't.
Right.
And in 2020 it happened so fast, both the drop and the comeback, that I'd argue that that's kind of got put out of people's minds as well, because
Absolutely.
of the snapback in value. So kind of, being able to establish, what's going on in a portfolio, being short-term aware is going to be helpful as we guide clients through what we expect to be a more volatile 2022.
Well, Happy New Year. Like I said, by the time this video drops, and I got to be cognizant of our Steelers fans, although most, if I'm being honest, if you're a Bengals and Browns fan, Steelers have had plenty of success.
Let's 2 Super Bowls in the last 20 years. Yeah.
Let's have an Ohio professional team win a playoff game in 2022. Maybe we'll end on that.
I'm not going to go that far. Like, I'm not wishing you any success in the playoffs at all.
Fair enough. I look forward to visiting an arcade with you in 2022 and playing some NBA Jam.
Look forward to it, Dave. Take care.
See you, man.